Wow, thank you for having me here. I am the co-founder and CEO of Caliber, the wealth development company. And just like the SALT conference, this year Caliber is celebrating our 10-year anniversary in business. Today I thought we'd dig into a seemingly simple topic, what makes for a good opportunity zone investment. In a few minutes I'll sit down with Marc Schultz, a preeminent attorney from Snell and Wilmer, who's been focused on opportunity zones as a specialist. He's spoken at the Biden Institute, many state conferences, and his provisions on the regs, most recently around leasing and some of the other tax conformity issues, just made it into the law. Before Marc joins us, I thought I'd take a time to share some of my thoughts with you. I've had a chance to take a look at the lineup at the conference, and thinking through the many topics surrounding opportunity zones, I noticed there might be a gap. To fill that gap, I thought I'd take the liberty of making the case to invest in opportunity zones in the first place. I'm sure many of you are similar to the thousands of people we've spoken with across the country over the last 2 years, in that you might have heard the topic, you might have explored it. Maybe you've made it through a day or a week without hearing the word opportunity zone. Maybe you haven't, and you're probably still considering how it fits for you. I'd like to share with you from my chair why this form of investing offers significant promise for years to come. First and foremost, the alpha. Opportunity zone investing, the ability to nearly double your investment returns through a tax benefit while still taking a reasonable rate of risk. If done right, thousands of communities can gain significant value from capital they may otherwise have never seen. If done right, investors will have a little fun with their capital, and they'll see that their funds matter to those communities, and they matter to the entrepreneurs that they're empowering. This program has the power to unlock dormant capital that would otherwise sit in an estate plan or rarely or never cycle back into the economy. From my chair, the time is now to find a time-tested real estate team with a proven process who can promise you long-term results and guarantee you that they won't mismanage the fund or the administration. Things are changing. Investors continue to demand a healthy return on investment while asset prices are at all-time highs. Tax programs like the Qualified Opportunity Zone program are a once-in-a-lifetime, maybe twice-in-a-lifetime opportunity. It's no longer safe for investment managers to ignore the fact that investors are looking for non-correlated real estate alternatives. And to take advantage of this new program, a new way of investing, new relationships have to come together, and new managers need to get qualified. So who am I to make the case for opportunity zone investing? To help you to decide how to select your strategies, your managers. For one, I'm the CEO of the largest Southwest-focused opportunity zone fund in the country. And in that role, I've spent thousands of hours over the last couple of years learning the strategies, meeting some of the best operators, understanding the marketplace and how it works. This is our 7th discretionary fund in a line of offerings that over the last decade could qualify us as one of the most experienced opportunity zone investors in the country. The $500 million in transactions we've done and the $500 million that we have in development are all essentially opportunity zone projects. A third, and perhaps the most important, we understand the complexity of properly executing a fund of this nature and can understand how to evaluate that capability in others with an infrastructure designed for a public company by public accountants. I'm here because of one simple yet elegant belief. I believe that when we build an industry from scratch the right way, and we help the good actors succeed, we raise the bar for everyone else, and we protect this nascent industry from the bad actors. Now, I can only speak from my own experience. The statistics are just starting to roll in on opportunity zones, although I can tell you that it's clearly gaining significant momentum. All of you here at the conference today, and Skybridge's choice to focus on opportunity zones is a clear indicator of that. Caliber, our company, has raised more money in the first quarter than we did all of last year because of our fund. And from the deal side, we've seen a 10 times growth in the amount of inflow of attractive investments with projected returns in the mid-teens or higher. So what are the obstacles moving forward? Finding the right fund manager, deciding if you want to do this on your own, choosing the right markets, choosing the right asset classes, choosing the right strategies, navigating the landscape of funds, understanding the use of leverage and risk, understanding the opportunities for liquidity. In 2018, many billions of dollars in capital were left on the sidelines, while investors remain in the dark about options in qualified opportunity zone funds. It's estimated the volume of opportunity zone funds will grow to $100 billion this year or greater of investment. This will only occur if investors can gain access to these funds through their teams or the institutions that represent them. On June 29th of this year, another round of billions of dollars of capital gains will lose investment eligibility as the gains earned in 2018 from partnership interests no longer qualify for their 180-day investment window. Potentially doubling your return with tax benefits while taking the same level of risk is truly a once-in-a-generation opportunity. Doing it while making a lasting impact on communities and deserving entrepreneurs makes this opportunity matter. Thank you, and I'm going to bring out Marc Schultz. We're going to sit down and have a little conversation about opportunity zones.
I was going to give you a high five. Oh. So Chris, I get to ask you questions, and you can send me the bill this time.
All right, well, there you go. Can I ask you the first question?
Sure.
So there's complexity here. Everybody knows that. I think we've got plenty of sessions that address some of that. But from your view, what is the complexity you see, and what do people have to look out for?
So this program is complex, and one of the reasons that has made this program so complex is how you structure these deals. So you have your opportunity fund, and that opportunity fund has a test that needs to be met twice a year. It's called our 90% test. And then the opportunity fund deploys the capital that it raises into what we call an opportunity zone business. Okay, so that's another entity. So we've got two entities. And that opportunity zone business has 5 requirements that need to be met. So you got 2 entities. You've got this big requirement at the fund level, and if you miss that, fail that requirement, then you're looking at a penalty. In fact, the fund is looking at a penalty. The investors are looking at a penalty. So we have this fairly complex program that is highly structured, and that actually is. Let me ask you this question, and that is, what is the infrastructure that needs to be in place for a third-party sponsor opportunity fund?
Yeah, so as I understand it, the intent of the law was to make sure that there was a fund manager in place, so there was an intermediary to sort of avoid some of the natural, maybe people trying to take advantage of this particular law to do a family investment but not have an intermediary involved. And so on our side of the fence, we have CFO with almost 20 years of experience from PwC, Director of Tax from Deloitte, Director of Financial Reporting from Deloitte, Controller from Big Four, and an entire infrastructure to help those folks just internally, not to mention the fact that we obviously hired you and some of the other great experts in the space, because you basically have to have the equivalent of a public company infrastructure to run one of these funds effectively, in my opinion. At least if you're going to do more than one asset and you're going to take in investor capital. Most of our brothers and sisters out there that have great entrepreneurial real estate businesses, they're really good at doing deals. And they have the best access to deals. But it's them, their assistant, their partner in an office. And so complying with the law, consistently reporting on a regular basis, it's a big challenge.
Sure. And I would imagine your investors would be very upset if they find themselves in penalty territory.
Yeah, because they have to pay. We obviously, no one would want that to happen, but that's the reality of the way the law works.
Yeah. It is a fairly complex law. It has, one of my friends was saying that he's like, I want to buy you a hat that says, make tax attorneys cool again.
Yeah, it's definitely funding that industry.
Next question I want to ask you is, we know this is what they call a shallow and remote subsidy. So it's not a direct subsidy to the project.
Right.
As such, it is important that the project makes sense from an economic perspective. So what are the returns that you are seeing in the projects that you're evaluating?
So we didn't change our approach to investing in real estate. These are development projects. The law requires us to buy something and either essentially do a heavy renovation or build from scratch. And so in order to do that, we have to get the highest return profile possible because we're taking on a significant amount of risk. And so typically when we do a project, we like to buy it, fix it up, hold it at a minimum of a 10% cap rate or better, lever it to a 15% or so cash flow rate of return, and then sell it hopefully for a 2 to 3 times equity multiple. That's normal in real estate development. If you don't do that in this program, the value of the tax incentive is actually fairly low, because the biggest incentive that comes from the program is 10 years from now, when I sell my equity or my shares of the Opportunity Zone Fund, I don't have to pay tax on the gain and the growth in the value. So if I just bought, a piece of real estate that had some decent cash flow through that 10-year period, but was only up 10, 20% or something like that, I'm not really getting a significant tax benefit. The biggest tax benefit comes when we can really grow the value of that equity. And so, it doesn't fit for every style of investing, and it certainly doesn't fit for every style of investor.
So, one of the objectives of the program is to lower the cost of capital.
Right.
And I know that might not be the case right now, but do you see that possibly being the case where, the investors would, take into account the yield from the tax incentive and thereby lower the cash-on-cash return or the expectation of the cash-on-cash return?
Yeah, I think so. I think that's where eventually it goes, because you're getting such a big tax benefit. But the more you lower that return down, you eventually do lose that third benefit. So it's important to do good projects. I mean, this doesn't change the type of real estate or related project you'd want to do. It just adds this additional benefit. The thing it does do for us is that it opens up a window of additional types of projects we can do. We have to invest for 10 years. There's a lot of flexibility on how we invest. And the types of projects we can move into, more of your mixed use, more of your creative projects that the community might actually want versus something that's easy to fund, that's where you're starting to see, I think, some improvements to the way we invest.
Let me ask you this. I see this, I talk to brokers who are telling me that, if your property is in an opportunity zone, that property is worth more. And so from your point, when you're evaluating, a premium on a piece of property, I mean, does that really make sense with this particular incentive?
Well, every broker thinks their property is always worth more, than it is, but I think we all know that. But I think they have seen across the country about a 20% increase in the property values just right off the bat, because anytime you push capital into a specific location or a specific area, the more you push into one place, the more likely prices are to rise. On the flip side, if you look at some of the projects, at least the ones that we're involved in, we are getting an acceleration of the level of development that's happening in a very small area. That actually compounds on itself, so it creates significant value over time. You don't just build one apartment complex, you build a couple of apartment complexes, you add a little walkable retail, you add some office, and that grows the compound value of the area significantly. So while land prices are up, I don't think that it offsets the benefit of the program.
Sure, and I always tell folks, this is an incentive that's there right now, but when you go to sell the property, there's no incentive that's going to subsidize someone overpaying on the purchase on the back end. So it's a wise move to make sure you're getting a good deal on the property and not expending your incentive on the premium.
Nothing changes from the world of real estate. You make your money on the buy and the start, and you still have to do that in this program.
Sure. So the second tranche of regulations came out on April 17th, right after tax day, and which was really, my friends who are accountants were not happy about it, because after tax day, what's the first thing they do? They go on vacation,
right.
And then
all
of a sudden
back to work.
these much anticipated regs were dropped, and all these folks on vacations were, their phones were being blown up. But the second tranche of regulations mentions these anti-abuse rules. They don't tell you exactly what is abusive, but in a number of places in the regs they mention, that we can recast your transaction if you're acting abusive. So what are the safeguards that you are taking to make sure that you don't have a transaction that can fall afoul of these anti-abuse rules?
Well, we hired you.
I'll give you a legal opinion on that.
No, I mean, that partly is it. You knew about this bill before it was even a law, and you helped us get very well positioned in the beginning to understand the intent of the law and the lawmakers versus necessarily what was available to us in terms of the regulations. I think as long as you're running a fund off that intent that's in alignment with the regulations, you'll do fine. One of the intents of that law was to not, find a way to make this a parking place for people to just park their capital. The entire intent of the law was to drive economic development and value to communities that don't as easily see capital, right? So you're talking Reno, Tucson, Arizona, Salt Lake City, Utah, Denver, Phoenix, et cetera. And so that's what we do. We're just doing, we think, good projects that fit with the alignment of the law, that fit with the regs, and that fit with that intent. But, I mean, you see more than I do across the country.
Sure.
What are you seeing?
Well, after the second tranche of regulations were released, I started getting calls from folks who are parking lot operators. So, because in the regulations it states that you do not need to substantially improve raw land. You still need to operate a trade or business on that raw land, and in the regulations they say, and if we perceive what you're doing as abusive, then we can recast that transaction and that raw land would no longer be qualifying property. So, in the regulations they give us an example of, I purchase an operating farm and I just continue to operate it, and they say that's abusive because you're not increasing the economic activity on the property or increasing the output of the parcel. But then later in the regulations they say that if you buy the land with a view of not to improve the property by more than an insubstantial amount, then you don't get to rely on this rule that says you don't need to substantially improve the land. So,
Right.
So we don't know where we are right now, but we know that we have a lot of folks that are saying, can I have just a bunch of surface parking lots in these opportunity zones, and I'm going to operate a trade or business on it? And the question then is, right, is that within the spirit of this this incentive that's out there to increase the economic activity in these census tracts?
I think everything in life is risk, right?
Right.
You're always, as an investor, you have this huge tax incentive you can take advantage of. You can invest in this program, which I think is a great program. But what level of risk do you want to take? Do you want to, potentially skirt the edge of that particular abuse rule and find out 2 years from now the IRS has decided that was not something you could do? Or do you want to, stay within the intent of the law? So there's a lot of people looking at all kinds of, marijuana deals and this and that and the other thing. But I think if you're building apartments and you're building hotels and you're growing economic development in that region and you're growing job base and employment, I think you're doing good.
That's right. I mean, you are, by definition, meeting the term substantial improvement, which is more than doubling the basis of the property on your deals. So this is a good segue into the next question. So we hear the term conscious capitalism, social and community impact investing, ESG, which stands for environmental, social, and governance, and SRI, social responsible investing. Some law firms now have set up practice groups that focus on impact investing. So what are your thoughts of whether this incentive fits within the confines of this impact investing space?
When they first launched the law, it was clear that there was an economic development thesis to this, and that was the main thesis of the law, right? So economic development means job growth, effectively, right? And other economic improvements. When we took a step back and said, this is a phenomenal law for our real estate private equity industry and for investors and for communities, because all these communities that we like to invest in don't actually see this kind of flow of capital normally. We said, well, how can we be a good steward or a good participant in the ecosystem and how can we show that we're actually creating what the law was intended to create? So we actually wrote an impact investing thesis into our private placement, and we're actually trying to figure out right now, how do we calculate that impact rate of return? because I do think investors will value that over time. And I think if we take the lead, and other great funds in the country take the lead to do that voluntarily instead of as a mandate, we'll have a lot of proof and a lot of data to be able to show legislators on both sides of the aisle that this was a great program. It did exactly what was intended to do, and we can continue it.
Sure.
Because I think it is the right way to invest going forward.
So have you had investors ask you to undertake a community impact study?
We haven't had anyone ask us to. We just figured out that it was the right thing to do. And so we're working with figuring out which companies to work with. I'll give you an example. So, we have some retail space in the city of Mesa. And it's a large amount of retail space in their main downtown. And we can probably rent it for about $25 a square foot. Well, we've got the 5th annual now Mesa Music Festival that needs a home to house its operations and such. So if we give away 500 square feet, 1,000 square feet to give the Mesa Music Festival a little office in one of our retail spaces and a place in a home and that kind of stuff, yeah, we're losing $25 a square foot times 1,000, right? But on the flip side, we're creating 20,000 artistic impressions. We're bringing much more livelihood back to that area, and that momentum is creating a desire to be in that downtown. So you've got to look at investing beyond just the dollars and cents. There are things that we can do that matter beyond
right, the intangibles.
Yeah.
And speaking of the intangibles, this incentive didn't come with any particular annual reporting requirements. So I do a lot in the New Market Tax Credit Program, and there's constant reporting that is necessary.
Yep.
And so one of the big things that, when I go around the country and speak at conferences, sometimes I'm on a policy panel, and the big thing that folks talk about is, well, what is the policy that should be in place here, and what types of projects get done? And the answer is that this is something that it's a flexible program, and it's up to the state and local communities to figure out what their policy is around this. I mean, some areas, are more focused on workforce housing. Some areas on the East Coast are focused on putting businesses in some of these abandoned buildings. But what are and this is now becoming a hot topic in Congress and with the Treasury, of, what are your thoughts on the data that should be used to measure whether this program is working as intended?
Well, there's no mandates, right?
No mandates.
At the end of the day, I think what do we want to know? We want to know, is the census tract that was identified as a qualified opportunity zone happy, right? Is it happy with the economic development that's being driven within that census tract? So we care about job growth, obviously. We care about maybe changes in the community. Maybe we're adding in a movie theater for the first time ever. Maybe we're adding in better access to transportation. Maybe we're adding in better access to education. All those things matter. So it's more about documenting what matters to that community. And it is very much, census tract by census tract. But on the flip side, we get to show that to the investors and show you, yeah, we're making you a great rate of return, and here's what else we're doing for you. This stuff is important. You get to see the stories and the pictures. I care about that, and our clients do too, because it's beyond just, hey, I got a good rate of return and I outperform the market.
Yeah, and I've heard different measurement tools. Some people say, well, maybe you look at the number of building permits that have been pulled, maybe the number of new business licenses. I've heard some folks say we need data on whether this increases the wages in this particular census tract. So this obviously is the hottest topic right now, outside of the substantive legal issues on, and especially if you're going to go to Congress and ask for an extension here or something.
Yeah.
The question is, well, show me the data that this is working. And right now we don't know what it is, but it's like someone said, this program it's like building an airplane while flying the airplane. So.
Well, I mean, you get to see. You've traveled all over the country. You've spoken at conferences in almost every state at this point in time. There's 100, 200 funds out there. What does the landscape look like to you? What kind of funds do you see? Are you seeing a lot of funds? We're a $500 million fund. Are you seeing a lot of those size? Are you seeing bigger? Are you seeing smaller? What does that look like?
Well, I see a lot of the funds right now are single asset funds. 20 to 50 million, somewhere in that space right now. the regs that came out were very favorable to multi-asset funds. And maybe this is a question for you, and that is, from an investor standpoint, with a multi-asset fund, I mean, you have diversification that is possible. And maybe this is a question on where you could talk about how you are diversifying your investments amongst the different asset classes.
Yeah, it's kind of an interesting question because when we first started our fund and we were on these panels and expert panels, we got a lot of questions on, well, why are you doing a multi-asset fund? That's very complex, right? And most of the funds in the country were single asset funds, meaning we're going to invest in this project, we're going to buy it for this, we're going to construct it for this, we're going to do this with it, we're eventually going to sell it. Very easy to understand. Problem is if you're an investor in, say, Brooklyn and Amazon pulls out of the national headquarters out of New York and doesn't go through with that deal, you might have put yourself in a really bad position. So you're stuck in one project or another, or if your operator doesn't perform or the developer fails or whatever. I mean, you've seen it all, right? And so we looked at our side of the world from a regional perspective. What's the largest region, the best region we can attach, happened to be the same region we're already in, which is Arizona, Colorado, Texas, Nevada, and Utah. And we wanted to invest regionally because we can still have those deep city-level relationships with people and still be able to get projects direct without having to have a disconnect between us and the projects or the developers, but not be too big, too national. So, I mean, that was our approach. I think a lot of these funds that are looking at one deal or one little market or whatever, they're taking a lot of concentration risk. But, everything depends on where you sit in your chair, so that's our chair.
So speaking of risk, one of the trends that we're seeing, a lot of states are throwing out different incentives towards these programs to attract, a lot of times the location of the capital is very agnostic, right? They're just chasing yields. And so different states are coming up with, different incentive programs, whether it's a tax credit or, something, property tax abatement. And what folks don't know, some folks don't know, is that you can use the opportunity zone incentive with other incentives. You can twin this all. And do you have any projects where you're using, another incentive?
Yeah, and we're seeing it from our friendly competitors across the country that they're starting to match up low-income housing tax credits and historic tax credits and things like that. We've got our first project that went into our fund is a ground-up construction of a DoubleTree Hilton hotel, and that included a tax incentive on the property tax incentive on the sales tax. So it just essentially just reduced the cost of us starting up the business. And to my knowledge, there haven't been a lot of tax programs where you can layer all these things on like we can with this. So it's been a great thing for us, and we're looking at every possible tax benefit we can gain with these investments.
Sure. I mean, one of the things that folks, a lot of the incentives in the tax code don't allow you to double dip with municipal bonds, right? And this particular incentive has no prohibitions with using this with any other incentive, and so it obviously would be malpractice for a developer not to consider other incentives that are available.
Correct, absolutely.
So we have 50 seconds left. Maybe we could talk for 30 seconds about our first meeting and when we introduced the OZ incentive.
Well, so I just had a baby, and she's our first daughter. And I get back to work, and there's this screaming, you've got to talk about tax incentives. There's a new law. It's the most amazing thing in the world. It's going to change and transform our industry. And I get to meet Mr. Marc Schultz. So it was meant to be between the two of us. And I'm lucky to have known you, and especially to have you as our wise counsel, because you've flown around the country. You've taught lots of other people about this. And I said it a little bit tongue-in-cheek, but for us to really dig into the details in half an hour is a little challenging. So thank you all for having us, and hopefully we get to see you again throughout the conference.
Thank you.